What if the real silver move hasn't even started yet? What if everything you hear about silver prices today is focused on short-term noise, while the forces that will define 2026 are already locked in place? Because when silver finally moves, it doesn't ask for permission. And by the time it feels obvious, it's usually too late. To understand where silver prices could be by 2026, especially in the United States, you have to stop thinking like a trader and start thinking like a system. Silver doesn't rise because of hype. It rises when pressure builds across money, industry, and confidence all at once. Right now, that pressure is quietly increasing. Start with the U.S. economy. Federal debt has reached a point where interest payments alone are becoming a serious burden. This isn't politics, it's math. When debt gets this large, governments historically choose inflation over default or deep austerity. Inflation quietly reduces the real value of debt, but it also destroys purchasing power. That environment has always favored hard assets, and silver is one of the most sensitive to it. Here's where many forecasts fail. They assume silver moves gradually. It doesn't. Silver compresses for long periods, frustrating holders, then reprices suddenly. Those repricing phases are what people remember and what most miss. By 2026, the conditions for that kind of repricing may already be in place. Interest rates matter, but real rates matter more. Even if the Federal Reserve cuts rates before 2026, inflation-adjusted returns on cash may remain weak. Historically, silver performs well when money feels safe but quietly loses value. Capital doesn't rush out all at once, it leaks, and silver absorbs those leaks before the flood arrives. Now add the industrial story, which is where this cycle becomes different. The U.S. is pushing hard into electrification, renewable energy, data centers, AI infrastructure, electric vehicles, and defense modernization. Every one of those sectors depends on silver, not as an option, as a requirement. Silver is one of the most conductive metals on Earth, and there is no easy substitute. At the same time, silver supply is constrained. New mining projects take years. Many silver mines are byproducts of other metals, meaning supply doesn't respond quickly to higher prices. Above-ground inventories have already been drawn down after years of deficits. By 2026, those buffers could be dangerously thin. Here's the critical point. Industrial demand doesn't disappear when prices rise. Manufacturers don't stop building solar panels because silver is more expensive. They pay the price. That creates a powerful feedback loop where higher prices don't destroy demand, they confirm it. Now think about positioning. In the U.S., most portfolios remain heavily weighted toward stocks, bonds, and cash. Silver is still a small, often ignored allocation. That's exactly why its upside can be explosive. Markets don't move when everyone agrees, they move when positioning is wrong. Another overlooked risk is the structure of the silver market itself. Paper silver dominates pricing. Futures contracts and ETFs work fine during calm periods, but during stress, the gap between paper claims and physical availability becomes obvious. When confidence cracks, price stops reflecting expectations and starts reflecting scarcity, and that shift can be sudden. Geopolitics only adds fuel to this setup. The U.S. is reshoring manufacturing and prioritizing supply chain security over efficiency. That sounds strong, but it's inflationary. Domestic production costs more. Military spending is also rising, and modern defense systems are electronics heavy. Silver demand from this sector isn't cyclical, it's strategic. So what does this mean for a 2026 silver price outlook? Not certainty, but asymmetry. The downside is limited by physical demand and supply constraints. The upside is driven by inflation, industrial necessity, and declining confidence in financial stability. Historically, silver lags gold early in precious metal cycles, then outperforms dramatically. That acceleration phase is what most people underestimate. By the time silver feels expensive, it's usually already deep into its move. The biggest mistake U.S. investors make is assuming they'll have time. Time to wait, time to rotate, time to buy back later. Silver doesn't reward that mindset. Its biggest gains tend to arrive quickly during moments of stress when access tightens and hesitation is punished. By 2026, silver doesn't need a perfect storm to rise. It benefits from multiple imperfect outcomes: persistent inflation, rate cuts, slowing growth, or weakening confidence in financial stability. That's what makes this setup so dangerous to ignore. The real question isn't whether silver could be higher by 2026. The real question is whether you'll still be positioned when it finally reminds everyone why it matters. Because history shows one thing clearly: silver's most powerful moves happen when disbelief is highest and participation is lowest. And right now, disbelief is everywhere.